Good morning, friends. My name is Monil Kapadia, and I'm CPA CA in Canada and CFA, and I am working as a tax consultant in Mississauga. The purpose of this recording is to walk you through the basics of tax system in Canada. So let me share you with the presentation. So the very first question that lies is whether you are obligated to file taxes in Canada or not. If you're landed in Canada in a specific year on a PR, and if you're established a residential ties in Canada, then yes, you are obligated to file your taxes, even if it's a zero return. Now, there are various benefits of filing the taxes. One of the benefit is you become eligible for certain credits and the benefits that government and the provincial provides to you as a newcomer. Now, one of the benefit is Canada Child Benefit. So if your child is below 6 years and your family aggregated net income is less than $30,000, then you get the maximum benefit, which is $6,500. If your child is above 6 years, they get $5,400. Now you can either fill up the form RC66 on your own and submit it to the government to process your application, or you can ask your accountant to take the child tax benefit when he's filing your return. Another benefit is HST credit. So you get a $375 for a family if you fill up this form and you are eligible to get that benefit. Ontario Trillium benefit is basically a benefit when you pay rent or you pay municipal taxes on your property and your income is below certain limits, then government gives you $1,056 max on paying that rent to support you against those taxes or rent. A WITB is a benefit which you become eligible when you earn between $3,000 and $17,000. So you work, but your income is still below certain eligible limits. And if it's below $17,000, then government will give you a working income tax benefits. Now, all of these benefits are eligible, or you do not have to file it separately. But when your accountant is filing your taxes, he will make sure that he will enroll you for all of these benefits and you start getting based on your net income that you make. Tax slabs. Now, this is one of the very basic questions that always come, that what tax slabs or how much taxes do I pay in Canada? Now, in Canada, there are two different rates based on different slabs. One is a federal rate and the other is a provincial rate. And that is why it is very hard to give a specific percentage for a specific income. So what I've tried to do here is I've created an income range and average tax rates that you pay. So say, for example, on a 50 to 70K income, you pay 24% taxes. If it's 100 to 120, you pay 29% taxes. The highest marginal tax rate is 54% when you cross $220,000 in income for a specific year. The basic personal amount is $11,809. So this is for 2018. What does this mean is up to a $12,000 of income, you are not supposed to pay any taxes. So you get a standard deduction. Now, if your wife is also not working and you both, then her limit also gets transferred to yours. And that's how your limit is close to $23,000. These are the basic tax terms that you need to know when you're filing your taxes. SIN, that's your social insurance number, which is a very unique number. TD1, which is a personal tax credit. So this form you normally get when you start a job. Your employer will ask you to fill up this form and you have to fill up various credits that you are eligible for, and that will enable your employer to see in what tax bracket you fall and how much tax is to be deducted. Normally, unless you have a disability or old age or any specific credits, we'll leave it blank and give it back. The reason is employer will deduct your taxes at a higher rate and then we can claim refund at the year end. We do not know what the situation is going to be throughout the year. So make sure when you roll up the TD1, you put specific numbers if you are eligible for certain credits on it. T4, this is an employment income slip. So T4 slip is basically a summary of all the taxes, your gross income that you made, the taxes that is deducted by your employer, the CPP and EI that is deducted throughout the year. This is the most important document that your accountant will require to file your taxes. Every employer has an obligation to create a T4 and mail to the employee by end of February. So the deadline to create a T4 is 28th February. So you might have either got it or you will get it by end of February or mid of March. So if you work for two or more employees in a specific year, then you get a T4 slip separately from each of those employers. If you have changed your address, then make sure you notify your previous employer that this is your current address, or you ask the HR to mail you the T4 slip. T5 is a dividend income. So if you have invested into mutual funds or if you are owning a company, then a dividend income is issued from the corporation or from your shares, and you get a T5 slip, which becomes a proof of income. T1 is a personal tax return. So this is basically the whole detailed return, which includes all of your income from various sources and how the taxes are calculated. This T1, you will get it after you file your taxes through your accountant. T2, corporate tax return. Similarly, if you have a corporation, you file a tax return, which is called T2. T2200. So this is declaration of conditions of employment. Now, this is specifically for those employees who are on commission basis or who are into sales and they have to incur expenses. So your employer will give you this form so that you are eligible to deduct certain expenses against the salary income, such as petrol, meals, home office, and so on. You can only deduct expenses against your employment income if you have this form signed by your employer. The T2125, this is a self-employed income. So if you have done a sole proprietorship, a freelancer, or Uber, or any other income that is not part of a full-time job, then you get a we fill up a T2125 along with your tax return. This is basically an income expense statement, which will have all the incomes minus all the expenses, and net income that you have made will go to your T1 personal tax return. The notice of assessment, this is basically once you file the return, it takes normally 2 weeks for the government to process your return and you get a notice of assessment. This is a proof of your income, and normally this is where you have to submit if you wanted to sponsor your parents or so on. This document become very important. You get the notice of assessment in mail from CRA. CPP, Canada Pension Plan. So you would have noticed in a full time, you get 2 more deductions in addition to your taxes, which is CPP and EI. The Canada Pension Plan is something that you contribute at a rate of 4.95% of your gross income. And the maximum you contribute is $2,600 in a particular year. The same amount is contributed by your employer. When you retire at the age of 71, you start getting pension based on the pool of this income that you contributed throughout the life. Employment income. So you know the maximum that you contribute against the employment income is $858. By taking the employment insurance, you get various different benefits such as parental or maternity benefits, or probably if you have lost a job, then you get unemployment benefits if you have paid EI and you are eligible after doing certain EI hours in a particular job. This is a specimen of a T4 slip. This is what you will normally get from your employer. You have the employer's name in this box. You have your SIN number. You have your details, name and address. The box 14 will say your gross income. The box 22 will say how much taxes were deducted. The box 16 will say how much CPP was deducted. And the box 18 will say how much EI was deducted. So these are the 4 or 5 columns which are very important and which will help your accountant to file your taxes. Deductions. So let's talk about the deductions that you get against your employment income if you are a full-time. RRSP, the Registered Retired Savings Plan. So this you get based on the room available. The room is made based on 18% of your prior year employment income. So if this is your first year, then you do not have any room and you cannot take this benefit. But if this is your second year, then your room will be 18% of your employment income for the prior year and max up to $26,000. So say for example, if you're not contributed for the last 2 or 3 years, your room gets accumulated and you can contribute everything together. The way this works is, say for example, if you have $100,000 income and you contributed 10,000 to RRSP, so your income will be 100,000 minus 10,000, that's 90,000, and you are taxed based on the 90,000 tax slab. The 10,000 that you contributed to RRSP, you can take it out tax-free when you're retired at the age of 71 years of age. If you take that money out in specific year before your retirement, then that amount is added to your total income and you are taxed in that particular year. Professional dues. So if you have paid any professional dues, say for example, I am a CPA and I've paid CPA fees, then I can claim a deduction for the fees that the annual membership fees that I've paid. Disability supports deduction. If any one of your family member has a disability, you need a doctor certificate, and there are various disability credits available against your income. Charitable donations, political contributions, there are certain limits and certain percentage of credits that you get. But if you've done a donation towards the eligible charitable trust, you get a tax receipt, or if it's a political contribution, you get a tax receipt and you can claim credit against those. First home buyer's credit. So if you have bought your first home, then make sure you talk to your accountant and say you have bought the first home so that you get a $750 in the tax benefit. The benefit is $5,000 and you get 15% of $5,000 as a credit. So your tax liability is reduced by $750. Child daycare expenses. So if your child is going into a daycare, you get a tax receipt from your daycare and you can claim those expenses against your income. Medical expenses above certain limits. So if you have incurred certain medical expenses and it is not covered under the insurance, and if it's about $2,300, then you can claim those expenses against your income. Tuition fees paid, T2200-2A. So if you've paid certain tuition fees or paid university fees, then you get this form from the university and you can claim credits against that. Now you can transfer the credits to your spouse. So say for example, if you are working, if you are studying throughout the year and have small or no income and you have paid any tuition fees, then you can transfer those credits to your spouse and he can claim those benefits. Interest on student loan. So if you have paid any interest on student loan, you can take the benefit out of it. Foreign property and income. So especially with the new immigrants, when you come to Canada, your global income is taxable in Canada after you land. Any income that you have earned before landing is not taxable in Canada, but you still have to disclose that income to the CRA. The moment you land in Canada, any income that you have earned in any part of the world, you have to disclose and pay the taxes in Canada. The benefit is you can also take a foreign tax paid credit. So if you have paid any taxes in foreign country, you can get credit out of it. If you have a property in outside Canada, then you are supposed to disclose that property if the value of that property is above $100,000. When I say property, it consists of cash, fixed deposits, gold, real estate. So sum of all of this, if it is above $100,000, then you are obligated to disclose it to the government. If you have a real estate property that is bought, say 5 years back, and you landed last year in Canada, then the acquisition cost of that property becomes the market value of the property when you landed in Canada. So if you sold that property, say next year, then the capital gain for Canada will be the acquisition cost when you landed in Canada minus the sales value. So make sure you have proper records of the valuation of your property when you land in Canada. Now, let us discuss some tax planning and optimization techniques. RRSP contributions to be carried forward. So if you have a room of RRSP and if you have contributed to RRSP, it is not required or necessary to take the benefit of that RRSP. You cannot claim any benefit and carry it forward in the next year when you have a higher income and you get more benefits out of it. Tuition fees to be split with spouse and carry forward. Again, as I said, if your spouse is studying and you're paid tuition fees, you can take the credit, you can split it Again, if you are if you are partially here in Canada and your income is low, then my suggestion is to carry it forward in the next year, when in the full year you have higher income and you can take benefit of it. Contribute to RRSP to avoid jumping the tax bracket. So you jump a specific tax bracket at a specific income. Now, if you jump those tax bracket, you can contribute $2,000 or $3,000 into RRSP and stay in the lower tax bracket. That's how you save marginal taxes. File family return together. This is very important, to file husband and wife's in return together. The reason is, if you file together and if one of your spouse is not working and her income is zero or his income is zero, then his or her $11,000 standard deduction gets transferred to you. So up to $22,000, you are not liable to pay taxes. Second benefit of filing together is, if you have any credits or any RRSP or tuition fees or donation or political contributions made, you can split or you can transfer to the higher taxpayer. Tax-free savings account, TFSA. This is one of the very good tax savings tool. This is basically, you can invest the money after you pay the taxes. So you do not get a tax benefit out of it, but any income that you earn in the tax-free savings account is totally tax-free. So after paying taxes, whatever income you have, if you invest in TFSA and you made capital gains or you earn dividend, it is totally tax-free. You can withdraw this amount at any point in time. There are no restrictions on it. You get, so the room for the TFSA is $5,500 a year per taxpayer. So if it's you and your wife, you both landed in 2018, you have a room of $11,000. For 2019, the room has increased to $6,000 per person, and the room gets accumulated. So if you have not contributed, you have a bigger room and you can contribute this at any point in time. Please make sure that you start investing the monies through TFSA. This is a very good tax-free savings tool available from government. RESP, a registered education savings plan. The government gives you 20% of the amount that you put in RESP. And this is basically for your child's education. The money gets into RESP plan, and up to maximum of $500 is funded by the government for your contribution. So say, for example, if you contributed $2,500, 20% of that $500 is added by government. So your total fund at the year end is $3,000. And when your children is at the age of 17 years, they can withdraw this money for the university. Split home buyers credit, donations, political contribution. This we already discussed. So if you file tax returns together, you have the benefit of splitting this contributions. Refund and my CRA account. Now, normally CRA does the assessment in 2 weeks time after you file your taxes, and you get a refund through a check, or if you have provided a void check to your accountant, then he will be able to set up a direct deposit so that the amount gets directly transferred to your bank account. The benefits or the credits that you have claimed for, say, for example, you claimed a home buyer's credit or donation or tuition fees, make sure you save those supportings, because CRA may ask for those supportings in future. Create my CRA account. This is one of a very good tool that CRA has provided. This will have record of all the tax filings that has been done in the past. So it's more of an online account for CRA. You can only enroll to the My CRA account after you have filed your return for once. So if you have never filed your return and you are newly immigrant, you cannot create the CRA account. Wait till your accountant has filed your return. Once he has filed it, you can Google My CRA and create this account. This will have records of all your T-slips, what return has been filed, your notice of assessment. So it will create a history of your records, and you can go and search any of your prior year's tax returns. Set online mail to get the e-copies and notice of assessment. Again, when you create the CRA account, you will have the online mails, so that every notices that comes and sits in the mailbox, so that you do not miss or you do not have to wait through the mails. How to file the taxes. So normally you can go through an accountant. With me, what I do is I have an individual return Excel checklist. you have to fill up that checklist and attach all the supportings like T4, or if you've done a donation, then donation slip or a tuition slip, and then I will file it up before the deadline. So the deadline to file for a personal return is 30th April. You're supposed to file your tax return, and if there are any dues, you are supposed to pay before 30th April. One of the questions that always comes to you as a new immigrant, whether you should go for a full-time or a contractor job. So it is personal preferences. From the tax viewpoint, you save at least 10% taxes if you go for a contractor job and you incorporate yourself. The other benefits are if you can expense most of your spendings through the corporation. So your fuel, meals, home office, laptop, or any business expenditure, you can spend it against the income that you make. Tax deferrals, if you're jumping a specific tax bracket, then we normally can take the benefits of tax deferral. We do not withdraw the whole amount and push it forward in the next year through a corporation. There are certain tax split opportunities also available when you do a contract job. Both spouses directors can expense out. So if you have a corporation and if your spouse is helping out in the business, then you both can also be director and can expense out the spendings. This is how normally full-time versus a contractor will work. This is based on certain assumptions. But say, for example, if you're making $100,000 in a full-time job, you pay $29,000 in taxes. So in hand is $71,000. If you're a contractor and you incorporate, you can spend, say, for example, up to $25,000 in expenses. Your net income is $75,000. You pay a corporation tax of 15%. This corporation tax has reduced in 2018, and for 2019, it has reduced to 12.5%. So there is more benefit out of it. And when you withdraw the amount after taxes as dividend or salary, you pay personal taxes and you get certain HST credits. So net, you pay 15% versus 29%, and you have a saving of at least 10 to 15%. Now, this is based on certain assumptions, and we need to see individually how it works. But in any case, if you are a contractor, it's good to incorporate and take various advantages of incorporation. We have listed the services that we provide. We do the federal and provincial incorporation. We also register for the HST and do the bookkeeping. Preparation of the financial statements. So if you are an incorporation or a sole proprietor, then we help prepare the financial statements. We file the corporation returns, HST returns, personal returns, and self-employed returns. We also do the tax planning and optimization consulting based on individual needs. If you're a new startup, we will help you to set up the books of accounts to start the business. What are the things you need to consider and how to plan things so that you are well informed before starting a new corporation. If you've got any CRA queries, we reply to those queries. Thank you so much for attending this webinar. I have my contact number listed here and my email ID. If you have any questions, you can please reach out to me. Thank you so much.